Alright, so today I wanted to make a video on a stock that I believe I've never talked about before, or at the very least made a specific video about. So this is ALLE, Allegion. Again, they're in the industrial sector, $10.9 billion market cap. Let's get into it here. Allegion engages in the provision of security products and solutions that keep people safe, secure, and productive. Provider of security products, services, and solutions throughout North America. The segment sells a broad range of products and solutions, including locks, lock sets, key system, door control and systems, exit devices, doors, accessories, electronic security products, access control systems, and software and service solutions. Again, so it includes commercial, institutional, and residential facilities, including education, healthcare, government, hospitality, retail, commercial, and single and multifamily markets. So again, they're fairly diversified in that they don't really just cater to the general public or just the government or whatever, right? Or industrial. So the reason that I'm interested here is, again, from what I can tell, it looks like it's a good company. But on top of that, I think it's an industry that's going to continue to grow because crime, again, depending on which numbers you look at, some people say, oh, crime actually isn't up. But at the end of the day, perception is reality when it comes to this stuff. And there's no shortage of areas in North America to where crime is an issue. Whether it's just perception is reality to some degree is irrelevant, because it clearly is an issue to some degree, and that is why I think a company like this is going to keep doing good. And at the end of the day, North America, the population is growing very quickly. And when you have a population that's growing very quickly, well, I think companies like this are going to do well. Now, again, from the outside looking in here, the first thing that I noticed here is if you take it from its peak back in 2020, the company is actually down about 8% here. I mean, if we look at it, it's actually about 6% by the looks of things. But still, it's down from that peak. It's also down from the even larger peak back in later of 2021. But I think that that's a little bit irrelevant. And honestly, I mean, it's cherry picking, because if you take it from its low back in 2020, it's actually up 51%, which, again, 51% in 4 years, that's whatever, 12, 13% per year, right? So I wouldn't be super concerned about that. Again, if we get right into its numbers here, let's not waste any time. Again, profitability, they're good, not great. I mean, gross margin, operating margin, net margin, free cash flow margin, those are all respectable numbers. Management's doing a good job. I mean, 40% return on equity, 21% return on invested capital is very good. Financial health, they're okay. They're not great there. Growth, again, this is an area they are actually growing fairly well. I mean, not great, but fairly well. Dividend is very good. I'll get into that. And again, they're projected to grow earnings by 19% over the next year, which is very good, right? And it's also below all of its historical averages. And I mean, it's got a PEG ratio of just over 1, which is pretty good. So that's something that I like. But again, if we get into the financials here, again, just under $11 billion company with $3 billion in debt. That's a little bit more than I would like, but it's not concerning, if you ask me at least. If we go into its income statement here, again, they've grown revenue very consistently. But I mean, I wouldn't say very consistently, but pretty consistently. But as you can see, I mean, going back to, 10 years ago, they were at about $2 billion. They're at about 3.5 or 3.6 now. So, I mean, they haven't even doubled their revenue over the last decade, but they are growing it fairly consistently. I mean, the only year where they were down was 2020, and I think that's understandable that a lot of companies were hit hard in 2020. So I like that. I mean, if we look at its gross profit, that has almost exactly doubled over the last 10 years, which again, that's good. If we look at its net income, again, 540 as opposed to 229, 10 years ago is actually less. So they have more than doubled their earnings / net income. Again, they're not growing it consistently, but I mean, I think 2020 is an anomaly. And again, when you look at its earnings as well, again, that's also at an all-time high. So Every metric here is at an all-time high, which is exactly what we want to see. If we look at its shares outstanding, that's the one thing I didn't bring up. They've actually left it steady over the last couple of years, but I mean that has gone down from 97 million in the year ending 2014 to 88 million. So I mean that's what, maybe 1.5% per year. So again, I mean if they buy back 1% of shares over the next 10 years on average, I would be okay with that. If ideally they do more, but that's still okay. If we look at its margins, again, this is something that they're also very consistent. I mean, their operating cash flow margin has been over 12% every year for the last decade, and I mean it's 16% at the end of 2023, so that's good. Again, return on equity has always been very strong here. I mean, very good. Return on invested capital has always been very good. So again, this number means here that, again, management is doing a good job. The lowest return on invested capital they've had going back a decade is 20%, which is very good. That's very good. I mean, they're 23% last year. If we look at, again, free cash flow per share, operating cash flow per share, also, again, at an all-time high. They're growing that very nicely. And if we go back a decade, 2.63 to 6.8. So again, they've more than doubled their operating cash flow per share over the last decade, which again, that's good growth, but it's not great growth. I mean, there's companies that have 5, 10x their operating cash flow or free cash flow per share that I've talked about, which again, I think that's unrealistic for a company like this. Again, just my opinion. Again, the last thing we'll get into here, again, dividends. Again, they've grown their dividends. They've actually been slowing their growth. 10-year, 19%. 5-year, 12, 3, 10. So again, it looks like the dividend growth is slowing a little bit, but if we look at its payout ratio, it's still at 31%. So I don't see them reducing it that significantly much more, but it's looking like, I mean, I don't see why they couldn't grow at 10% a year personally, but I think that's something that I do hope that they continue to grow at least 8 to 10%. To me, that seems kind of weird if they wouldn't do that. So let's get into the valuation here, just to get into that. And again, if we look at its going back a decade, its operating cash flow is the most predictable metric. It's been between 15 and about 30 for that whole time. And if we look at it right now, it's at 18.7. The lowest it's ever gotten was 15.1, and the average is about 21.1. And again, if they're projected to grow earnings by 19% next year, that's more than they've grown it historically. So the main reason that I wanted to bring up this stock is that I think that if anything, it's undervalued where it's at right now. If we look at its historical growth rates, I mean, they're growing roughly what they've always grown at. I mean, if we go back about 2 years, again, they've actually grown faster over the last 2 years than they historically have. If we go back about 3 years, again, it's actually a little bit less, but again, that's starting at a worse spot. If we go back 5 years, a little bit slower, but again, given analysts have them projected to grow faster over the next year as they historically have, that's why I'm a buyer where it's at right now. And again, if we look at its valuation, again, this is just my projection here. Do your own due diligence. I have them trading, again, growing operating cash flow 10% per year over the next decade, which is almost exactly what they've grown at. Again, 10.43 over the past decade. And then trading an 18 price to free cash flow, which is 21 is their average. That's 10% below. Growing their dividend 10% per year, and that's also not buying back any shares, which I think they probably will. Let's add it in here. If they buy back, or if they buy back 1% of their shares, let's say they even grow operating cash flow at 9% per year, just to be safe here. That still has them growing at over 10% per year, with the fair value being at just under 133, which is 6% above where they are right now. So, based on those numbers, again, I would be buying this stock right up until about the mid 130s. If it goes over If let's say it goes over 140, I would sell. But again, below 130, like where it's at right now, I'm a buyer. Again, it's right around 125, just under, at least the day before making this. So again, this is a stock that I like. Again, the one caveat I would throw out here is that I don't think you're going to get crazy good growth. But I think that the industry has tailwinds. And again, historically, it's done well. I mean, historically, let's take a look here at it compared to the S&P. Again, going back a decade, they've actually underperformed slightly. But I mean, that's due to actually looks like very recent. Up until, I mean, if you take it from March, from the end of March, it's actually almost the exact same. So, and again, I really like the dividend growth here as well. But the main thing to cap it all off here is I like the industry that it's in. And again, 4.5% free cash flow yield, 5% earnings yield. Again, that's another thing you want to see in higher rate environments. You want that higher earnings yield. So anyway, that's what I wanted to bring up today. If you liked the video, please like, subscribe, comment, and stay tuned for more.